A big story this week on the U.S. corporate front will be Nvidia earnings on Wednesday. Let's get perspective from Michael Landsberg, Chief Investment Officer at Landsberg, Bennett Private Wealth. Michael, thanks very much for joining us. Let me ask you up front, are you sick of AI? Do you think we've been hearing too much about it?
Andrew, it's certainly a possibility. I mean, I think the growth is going to be phenomenal. The thing I think you've got a lot of companies that don't really have an AI strategy. They're trying to make one up to be able to participate in this rally. So I think you've got a lot of that, kind of posers, if you will. And there are obviously those companies like Nvidia that are at the center of the universe of AI that continue to drive a lot of this growth and a lot of this universe.
Do you think, are you interested in Nvidia or those AI darlings? Are they holdings of yours?
Yeah, we've actually owned Nvidia since 2019. It's been a long holding. It's actually the largest holding we have in our portfolio. The difference is we have a tendency to rebalance. We like to rebalance portfolios from a risk standpoint. So we haven't had to get kind of away from us, if you will. And we've added to it when it's been down. We've been buying it when it's been down and trimming when it goes higher. The issue is, right now from a diversification standpoint, if you look at the world's indices, Nvidia is larger in the an MSCI World Index than France and Germany combined.
Wow.
And that's a problem for investors. So we look at it, and you mentioned, for example, the Canadian market's done better than the U.S. market. Most of the world's done better than the U.S. market, kind of sans Nvidia. So I think people do need to look to diversify. I'd be shocked if anybody watching this doesn't already own Nvidia. The key is if you own it, it doesn't hurt you to trim here and there to keep a risk tolerance. But you can go overseas now and get really good opportunities, not hurt yourself performance-wise and lower the risk in portfolios, which I think that's the big concern for many people we see, is they've got all their eggs in this AI basket. And while the basket's been good, the basket's gotten riskier and riskier as it's gotten more concentrated.
You have an interesting insight for us that the data indicates that retail investors lately have been far more aggressive, buying on margin, for example.
Yeah, some of the data that we've seen has been, they've been buying on margin, they've been buying the meme stocks. And when you look at the institutional market, kind of defined by the futures data, they've been short. They've been short the S&P 500 and very short the Russell 2000. And that's one of the reasons you saw the Russell pop nearly 4% on Friday. A lot of the institutional community is very, very hedged. And as the markets have done better because earnings have been better, you've been seeing a lot of hedge funds, institutional managers playing catch up because they've underperformed the retail investor badly this year. And I think it's been interesting because typically that's not what you see.
Is there anything that's coming down the pike that you think investors aren't aware of? Is there some kind of fright, you think? I know a black swan event by definition you can't predict, but is there anything that people are discounting too much?
Yeah, I don't think so, actually. I think the opposite's the case. I think there's a good group of people in the United States that will look at data and will find a reason to be negative. And maybe it's the dislike of the current president or what have you, but you look at it and the data comes out, inflation's in pretty good shape. The fact that we're cutting rates when inflation's sub 3% is a head shaker to me, but we're there. Unemployment's been pretty low. I mean, it's not like we've got a lot of employment. And I think everybody's underestimated the strength of the earnings. They've overestimated tariff impacts. So I think there's a lot of things that have been baked in that are negative, and that's why you've started to see the market move higher, because it is climbing that wall of worry that so many people have said this is going to kill the market, kill the economy, and it just really hasn't. Earnings have been really, really good, up double digits on the S&P 500, up over 20% in NASDAQ, and even higher in the Russell. And I think the rest of Wall Street was not really positioned for that. That's why I think this has got some legs to it.
But it sounded like you are not convinced that an interest rate cut is in order with inflation at current levels.
I'm an old school guy. I like to cut rates when we need to. And right now, if you told me, hey, inflation's sub 3% and unemployment's around 4%, are we cutting rates? I'd say there's no way we're doing that looking at history. Again, I think we're in a different environment, but I don't really see the reason. The stock market's at basically all-time highs or pretty close to it. Risk assets are very high, with Bitcoin being where it is. That's typically not a time you need to lower rates to get things moving. I do think it'll move things, but my fear is, do we burn out like gasoline as opposed to having a long fire? I'm a guy that likes to have a long, like wood on the fire for a long, long time, not gasoline on the fire for a short time. So that's my concern. If we get rate cuts, does it kind of scorch us up here? We move higher quickly, but if it has any legs, and I think we would have legs based on the earnings story. Adding more flame to the fire right now, it's going to work, but I'm not really sure we need it.
You have some stock ideas. Ensign Group, they provide a whole bunch of services for seniors.
Yeah, we're looking for things that are not in AI. AI is a big theme for us. Cybersecurity is a big theme for us. But other themes that we look at is people in the United States are getting older. We call it the aging of America. And whether it's knees and hip replacements, this is the senior centers. They do outpatient, they do rehab, PT, OT. And that's a business where as boomers get older and older, they're going to want to move to these facilities that are kind of one-stop shops. These folks have double-digit earnings growth. Revenue's been very strong, and there's not enough of these around. And so I think demand for these is very good. So pricing is very good. I think there's a lot of ways to play it. We like this as a smaller cap name. There's a little bit more beta here because the fact that it's smaller, I think there's more upside.
And you have at least one other stock idea, Interactive Brokers. What's the attraction here?
Interactive Brokers is a great name in kind of around the world in institutional trading. What they've done is they've actually started to grow their business overseas. They've got basically account growth is 30% year over year, but they've got a lot of business now. They're starting to move overseas, and the margins are nearly 70%. So they make money. More active trading means more money, more revenues for them. And I think what happens is they've got better tech than a lot of these online trading, so they're also picking up institutional business. And I don't see trading volumes going down anytime soon. And so I think as the market goes higher, typically you'll see more and more people step in. They're right where they want to be in terms of getting both retail and institutional with high margins.
And finally, Philip Morris International, a lot of their focus is on these pouches of tobacco as they move to a smokeless world. You think they'll navigate that successfully?
Andrew, we've owned Philip Morris and Altria probably 25 years off and on for different things. We've been excited more recently about this kind of Zyn and the smokeless, really for two reasons. I'm not going to say it's healthy. It's more healthy than the alternative of actually the tobacco or the smoking, but also from a regulatory environment, there's a lot less pressure on them. And it was one of the things that we saw really early on in this administration. Robert F. Kennedy Jr. was at his testimony and he had the Zyn with him. So I thought, okay, if this guy who's in charge of the health has got these, this is probably not going to be a huge regulated event. And it's a lot more profitable to make these than it is to actually do the tobacco. So I think you're getting less regulatory pressure and the margins are better. And again, it's a non-AI name, which I think people have concentrated their portfolios to the point where everything they own is in that space. You can make good money in these three names, for example, outside of that space, keep your diversification high, which will lower your risk. That's my concern for a lot of people that are doing this on their own, is they keep buying more and more of the same space. Their beta or their risk is a lot higher than they thought. They certainly saw that in March and April. And by diversifying, you're going to lower your risk and not hurt your performance.
Thank you very much indeed. Have a great week, Michael. And thank you very much for giving us the time today.
My pleasure, Andrew. Good to see you.
Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth.